Right now, somewhere in America, a 34-year-old has $47,000 sitting in a 401k. She gets a statement every quarter. She has no idea what any of it means. She's not stupid. She has a master's degree. Nobody ever explained this to her. This video is the explanation she never got. And there's one thing about how the stock market works that almost everybody gets completely backwards. We're going to get to that in about 4 minutes. A few months ago, a friend of mine, we'll call him Jordan, texted me, "Hey, my company just enrolled me in a 401k. They said pick a portfolio, aggressive, moderate, or conservative. What does that even mean?" Jordan is 28. He has a good job. He pays his taxes. He has literally never had anyone explain to him what he's actually buying when he buys a stock. And here's the thing. Jordan is not the exception. Jordan is the rule. Most people who own stocks through a 401k, an IRA, or an app don't actually know what a stock is. They know it goes up sometimes and down other times. They know it's stressful to check during a bad news week. But the actual mechanics, nobody taught them. So let's fix that right now, starting with the most basic question. What is a stock, actually? Imagine your friend opens a pizza restaurant. It does well, really well, but to open a second location, she needs $100,000. She doesn't have it. So she comes to you. "I'll sell you 10% of my restaurant," she says. "You put in $10,000. If the restaurant makes money, you get 10% of the profits forever." You agree. You now own a slice of her business. That slice, that is a stock.
A stock is simply a small piece of ownership in a company. Apple has billions of shares. You can buy one. And when Apple makes money, you own a tiny fraction of that profit. When Apple becomes more valuable as a company, your share becomes more valuable too. And if Apple has a terrible year, well, your pizza slice gets a little smaller. But here's where most people get confused. They think they're buying stocks from the company itself, and that's not quite right. Now, if a stock is a piece of a company, where do you go to buy one? That's where the stock exchange comes in, and it's probably not what you picture. Most people, when they think of the stock market, picture Wall Street. Guys in suits, screaming numbers, a giant scrolling ticker, phones everywhere, pure chaos. I mean, that used to be accurate. It's less screaming now, more servers in a data center in New Jersey. Slightly less cinematic. Here's how it actually works. When a company wants to raise money, say $100 million, they go through a process called an IPO, an initial public offering. They sell slices of themselves, shares, to the public for the first time. That's the only time you're actually buying from the company. After that, every stock trade is just two regular people or two institutions agreeing on a price. You want to sell your Apple share? Somebody else wants to buy it. The stock exchange is just the platform that connects you, like eBay, but for tiny pieces of companies. But here's the thing. If stocks are just two people agreeing on a price, what makes the price go up? And more importantly, what makes it crash? That answer might be weirder than you expect. Now, this is the part that surprises most people, because the answer to what moves stock prices is almost embarrassingly simple, and almost nobody says it out loud. Ready for the thing that almost everyone gets backwards? Stock prices don't move because of earnings reports. They don't move because interest rate decisions. They don't move because some analyst said buy. Stock prices move because of what people think those things mean. Let me say that differently. A stock's price is not a measure of how good a company is. It's a measure of how many people want to own it right now.
Which is why a company can announce record profits and its stock goes down, because traders expected even bigger profits. Finance has a word for this. The word is irrational, but we all pretend it makes sense. So what actually drives what people think? News, expectations, emotions, rumors, quarterly reports, sometimes a single tweet from a person with too much influence. Short-term price movements are mostly psychology. Long-term price movements are mostly reality,
how profitable the company actually is. This is why serious investors don't check stock prices daily. They know the short term is noise, the long term is signal. Now, you've probably heard the term, the market is up today, or the market is down. But here's something weird. The market isn't one thing. It's a number. And that number is calculated in a way that's kind of arbitrary. When someone says, the market is up 2% today, what market? There are thousands of stocks. They all move differently. Some are up, some are down, all at the same time. So who decided there's a single number? That's where indices come in. An index is a curated list of stocks used to represent the overall market. Think of it like a fantasy football team, except instead of players, it's companies. The S&P 500 is the most important one. It tracks the 500 largest companies in the US. When it's up 2%, it means that collection of companies is worth 2% more than yesterday. The Dow Jones tracks just 30 companies, the most famous ones. NASDAQ is heavier on technology. None of them are the market. They're windows into parts of it. And just so you know, the Dow Jones was invented in 1896 by a guy with a notepad. It is not as scientific as it sounds, but it stuck because finance is sometimes just vibes that became tradition. But now, 3 myths. 3 things that sound logical about the stock market that are actually backwards. These are the ones keeping most people on the sidelines. Myth 1. You need a lot of money to start. The minimum investment on most platforms today is literally $1. Apps like Fidelity and Schwab offer fractional shares. You can buy 0.01 of an Apple share. You don't need thousands. You need a decision and a phone. Myth 2. You need to know which stocks to pick. You don't.
Index funds, which we covered earlier, let you own a tiny piece of 500 companies at once. No stock picking, no research, no guessing which company wins. You just own all of them. And historically, over any 20-year period, that basket has gone up every single time in American market history. Myth 3. The stock market is just gambling. Gambling is a zero-sum game. Someone wins, someone loses. The money just moves. The stock market is not zero-sum. When a company gets more productive, creates more value, hires more people, the whole pie gets bigger. Not just for shareholders, for everyone who owns a piece. Yes, it can crash. Yes, individual companies can fail, but the overall economy has grown in every generation since the Industrial Revolution. Owning a piece of that growth is not gambling. It's the longest-running bet in human history, and it has paid out every time. So, what is the stock market? It's a system where people buy and sell small pieces of companies. Prices move based on what people expect, not just what's real. Indices are just curated lists used to describe the whole thing. And most of the reasons people avoid it, not enough money, need to pick stocks, it's gambling, those are myths. Now, if you got something real from this video, one actual thing you understand now that you didn't before, the best thing you can do is subscribe. Because every week, Financial Arch puts out one video like this one. One concept, explained clearly, no jargon. The next video is about compound interest and why the difference between starting today and starting in 2 years is the equivalent of buying a car and setting it on fire. It's in the end screen. I'll see you there.